Mr. Greg Dickerson. How you doing, sir?
Doing great, Michael. Good to see you.
Awesome, man. Hey, one of the things I wanted to talk about after talking about on episode 2 is where the pain might be seen most prevalent. I think a lot of people who aren't in the weeds like us expect a repeat of '08, right? They expect the single family housing market, like my market of Fresno, California, fell 75%. There are actually people out there that think the market will fall 75%. It's not going to happen, folks. The debt structure is entirely
the housing market crash forecast by all the experts. What happened? Where'd it go? How come we didn't crash?
Exactly. So again, it's not going to be, well, what I want to do here is I do not believe we're going to have a mirror image of '08. The pain, the setup is not the same in residential. It's just not. It'll slow down. It could go maybe fall single digits, whatever. However, where there
you'll see a correction. You're going to see a correction.
Yeah. Where you see real pain and thus real opportunity is commercial, office, retail, maybe mixed use. There are some segments of the market that really could take huge haircuts. And I think it's going to be in commercial and commercial financing. What do you think of that?
Well, again, that's different too now than it was back then. And those markets are way different. But yeah, I mean, a lot of areas are still struggling with office and retail, and especially shopping malls, larger properties, things like that. The ones that are still thriving and doing well, obviously grocery centered, grocery anchored centers and strip centers in neighborhood suburban areas that are, providing core services. But yeah, a lot of the big office buildings and uses are changing. Hotels, that's another one that's still struggling.
You're right.
We're seeing a lot of distressed assets there. So yeah, the commercial markets have taken a bigger hit because of the pandemic. But again, as things change and you get back open, a lot of that can change. The housing market, it's completely different conditions in '08, '09. The commercial market was a big one back then too, but they rescued the commercial market with the mortgage-backed security purchasing, MBS and things like that, because they did not want that shoe to drop, after the housing market. That would have been a complete disaster. So, it's an interesting turning point where we're at. And as interest rates rise, that really affects commercial property valuations. So you could definitely see, some stress coming there just with the reset of interest rates on a lot of these interest only loans that have been taken out over the last, 3-5 years on some of these properties because of what they faced. A lot of them restructured their debt, went to interest only so they could get through this time in the pandemic. So a lot of that's got to reset here in the next year or so. So yeah, there could be some real opportunities.
Yeah, that's where I'll be looking, is because I think, again, my experience from the '08 crash was it was basically a debt blow up, right? The debt blew up. It forced activity, right, in the residential, these 2 and 28s, liar loans, all of these things that were blowing up. I've seen some very similar structures, interest only, bridge debt, very short term, right? In my world, when you have 12-month debt, that's dangerous because you don't know where the world's going to be. And if you have to go back in and have another appraisal and cap rates have gone up and your NOI is down, that's a double whammy. Suddenly your assets worth 50% as much. And you either A, are going to lose the property, or B, have to raise a lot of equity in an environment where your equity position is not happy. They don't want to throw more money at it. So I think there's going to be a lot of distress in some commercial assets. You're going to have deep pockets because you're going to have to carry it a while. But that's where I'm looking.
Yeah, cap rates have been following interest rates, very closely in a lot of markets. And, like I said, with income-based properties, if you get a 1% tick in, interest rates, that really affects the value of the cash flow that property's throwing off to an investor, which affects the value of what they're willing to pay for the property. And, then the next question is, well, what do you do with these properties? So some of them are vacant, empty, what do you do with them? And, right now, there's 2 segments of the industry that are doing extremely well. Housing, of course, because there's lack of inventory. So redeveloping, repurposing into residential. And then in, more suburban areas, you're starting to see warehousing and industrial become more and more popular with, at-home delivery, things like that, needing, last mile distribution centers in more suburban areas.
Yeah. Yeah. The thing I want to leave people with here is don't just assume it's going to be the same as last time. I think we are going to have some pain again as interest rates rise. There will be people in assets that aren't worth what they used to. It's not going to be the residential lending landscape is different. Adjustable rate mortgages are up 300 or 400%. but they're up from 0.5% of the market. They're now like 4.5%. When you have 30-year fixed rate debt and your mortgage, your rate's 2 3/4, you're not leaving that. You're going to do you'll get roommates before you lose that house because you're going to pay rent somewhere, and you probably are cheaper keeping the mortgage. So it's likely not going to be residential. There may be some markets that are just so overblown that it's a problem, but not national.
Last time it was more about the borrower than it was the loan itself. Really, it was, it was loans being given to unqualified borrowers.
Correct.
That really created the problem. Interest only was a problem too, because they started raising rates reset, and people couldn't afford the payments, which affected values like we talked about, and rates are on the rise. So there will be a correction in residential if rates keep rising, especially if they get in the upper 4s, around 5%. You're talking, 10, 20%, loss of valuation in properties or more in some markets. That will affect people's wealth because, if you lose all your equity in your house, you've lost your down payment essentially, and you can't tap that equity. So, that creates reverberations throughout the economy. But, at the end of the day, it's a very different environment right now. It's nothing like what it was in terms of the origination of the loans. These are qualified borrowers now that have to put generally 20% down. So there's obviously people that can get them in, 5% down or whatever, but at the end of the day, they're still qualified. They have income, they have verified income, verified jobs, things like that. There's a very small percentage of the market that's being done with, what they call stated income loans based on bank statements, but they're still verifying at least something. Whereas before, all you had to have was a credit score. It didn't verify anything.
Yeah. Social security numbers, but all you had to have.
I mean, if you had a 650 credit score, even 550, I think back in the day, I mean, you could get, these no doc loans and you just state your income, and it was crazy.
Yeah. Just add a zero. You don't make 40 grand, you make 400 grand. Yeah. That was crazy stuff. So again, I think there will be pain. I think 2022 is going to be an interesting year. I think there will be a recession this year. So that's going to create some opportunity. It just might not be where you're looking for it. Greg, where can people find you?
GregDickerson.com. All my info there, YouTube channel, podcast. Go check it out.
Very cool. Thanks, brother.